Let's converge back and continue. All right. I believe we've rested and freshened up at least for the last 10 minutes. So we'll have to run. At least let's finish this session in the next 50 minutes at least. It's a long section for ISV Clarity Project, and we've started it. So by way of continuation, we're looking at the authority and responsibility of the auditor in relation to ISA 200, looking at the objectives of the internal or independent auditor in accordance with international standards on auditing. So the new requirements make it clear that the auditor uses the objectives in other ISAs to decide whether additional audit procedures are needed beyond those required by the ISAs. So, as stipulated by the ISAs, if testings and compliance procedures have been meted out, it will now depend on the auditor to decide whether substantive audit procedures will be needed. So when compliance testing and procedures have passed the test, they may not need substantial procedures. So most audits are carried out based on sampling. We take samples as auditors. So auditors take samples to test a large variety of data. So we do testing of sampling some of the data to see if necessary or additional audit procedures are needed to be carried out. This is very important. And where the ISAs are exhausted, the judgment of the auditor comes in determining the scope and size of work, additional work he wants to perform on the audits. Also, evaluating whether sufficient appropriate evidence has been obtained. So in carrying out the audit work, there must be appropriate evidence sufficiently to say that this is the job we have performed and this is what we are concluding on based on this evidence. It's very important for the auditor. You can't just arrive at a conclusion or at an opinion without sufficient evidence to back that conclusion or assertion. This is important to take note of that. So ISA 200 also includes material explaining the importance or the important concept relating to an audit, such as management's responsibility, professional skepticism, professional judgment, and the inherent limitations that the audit, was bedeviled with. So ISA 200 explains the importance of this concept, and that's why the overall objectives, as the ISA states, is very important. So management responsibilities, what they ought to do, professional skepticism as provided by the auditors. They don't take everything at face value. The questioning, inquiry mind is the responsibility of the auditor. And also providing of professional judgment where necessary, because the shall states you must mandatorily follow the standards, but where your professional judgment is needed must be applied, and also state inherent limitations and issues you had that hindered your complete detailed work in the audit, and the limitations that must be stated during and after the work. Okay, so that's ISA 200 on the overall objectives of the independent auditor in the conduct of an audit in accordance with ISAs. So we're moving to another ISA, which is 200. So do we have any question on ISA 200? We're moving to, another standards, 210. So we're moving to 210. So based on 200, do we understand the basic concept of the overall objective of the independent auditor? Or do we have any questions, any observations based on this standard?
No.
Okay, thank you for that feedback, Julie. Any other person, any other challenge, any explanation? I believe it's clear enough. At least when you hear IC 200, you just remember the overall objective of independent auditor. Okay, so let's move to the next standard, which is ISA 210, agreeing the terms of audit engagement. Agreeing the terms of audit engagement. So the auditor is now required to perform specific procedures. So where he has performed compliance and he wants to add additional procedures to substantive, compliance testing are brief, but substantive are larger. So when you hear compliance testing in auditing, they are maybe based on a sample, but substantive are larger. They encompass a sample. You take a broader data longer than the fewer sample you took to establish whether the preconditions of an audit are present. So in agreeing the terms of the audit, the auditor is now required to perform certain procedures to establish whether the preconditions of an audit are present. And these conditions include determining whether financial reporting framework to be used is acceptable. So where we were using SaaS and we transitioned into IFRS, the auditor needs to determine whether the financial reporting framework to be used is acceptable. So is IFRS acceptable or the framework of that local jurisdiction acceptable? So he needs to determine that based on this standard. Also, obtaining management confirmation that it understands the auditor's responsibility and management responsibility in writing is very important. So take note of it. One of the challenges of the audit is the responsibilities of the auditor that want to be overridden by management, and it has to be clearly stated so that the auditor may not be seen as overstepping their bounds. This is important. So determining whether the financial reporting framework is applicable, like some countries are still not aligning with IFRS, they still use their local standards. So they need to determine that. Which standards are we using to prepare this financial statement? Is it GAAP? Is it IFRS? Or is it your local standard? And is it acceptable globally? So let's take note of that. Also, obtaining management confirmation that it understands the auditor's responsibility and management responsibility is also key. And understanding that the preparation of financial statements that are in accordance with our application framework is that of management. So they need to understand this responsibility. The auditor is just providing an opinion. He is not preparing. So management's responsibility is to prepare financial statement, and the auditor is to give an opinion on whether these financial statements are providing a true and fair view. So the responsibilities are clear. Also, the implementation of internal controls that will enable the preparation of financial statements are free from material misstatements. And this responsibility is that of management, clearly. It's not the job of the internal auditor to install internal controls or to prepare financial statements. His own is to detect whether they are free from material misstatements and provide that in his opinion or assertion. So take note of that. Also, providing the auditor with access to relevant materials and all additional information with unrestricted access to employees is the job of or the responsibility of management. So based on ISA 210, these are the responsibilities of management. Also the revised, okay, let me go back to ISA 2. It's like Umar is having challenge with his network. I'm trying to admit him and this coming and going back. Network is a bit challenging. Okay, so based on ISA 210, management has their responsibilities stipulated out, while the reversed ISA of that 210 is ISA 580. Written representations requires the auditor to obtain written representation for management in respect of those responsibilities. So anything that is not documented is not done, in the words of my CEO, and that is graphically applied here. So in knowing management's responsibility, it needs to be documented and signed by management that this is your responsibility, so that when conflict arises, management will not say, you are overstepping your bounds. So the auditor will tell him, look, you've signed here that this is your responsibility and this is what you are supposed to do. We are not overstepping our bounds based on what you signed. So this is very important, and a written representation is key in providing clarity to the job at hand and the scope of work that is supposed to be done based on the scope and the audit work that is to be carried out. This is very, very important. So ISA 580 as revised stipulates that written representation, not just verbal representations, written must be clarified. It must be clarified in writing that this is the responsibility of the auditor and this is the responsibility of the management. Very important. So take note of that. So let's see below ISA 260. So in respect of the responsibilities, we'll look at below the communication with those charged with governance, that is management, communication between the auditor and those charged with governance, which is management, and that will be ISA 260. So based on 210, ISA 210, agreeing the terms of the audit engagement, which entails the responsibility of management, and also looking at the revision 580 that stipulates that agreement and responsibility should be in writing. We'll also look at ISA 260, communication of the auditors with management. That they are the ones charged with governance of the company. So do we have any questions? Okay, we don't, so let's move. So the revisions of ISA 260, which entails communication with those charged with governance, were intended to reflect significant developments to the regulatory and auditing standards in several jurisdictions and shifts in the expectation of those charged with governance and other stakeholders. So this standard was revised to help communicate these significant developments in that standard, and it entails communication, especially with the differences in jurisdiction, where some people apply the GAAP and some people apply the IFRS. So the communication and the development in this standard is necessary to help those charged with governance and other stakeholders understand their responsibility and their authority. So what are the additional requirements? They include explaining why significant accounting practices, which are acceptable under the applicable financial reporting framework, are not the most appropriate in that circumstances. So in updating this ISA 260, there has to be explanation, and that's the justification we talked about, that under their relevant financial reporting framework, it is practically impossible to apply this standard. So there should be communication in writing and justification of the same. Very important. So in those jurisdictions, for example, in Nigeria, there are no standards covering our petroleum upstream and downstream. So we need to justify it that, okay, based on the standards internationally, based on IFRS and ISA, this is why we are using our local standard. So there has to be justification and the reasons based on it, that these circumstances are not globally covered. So we have to use our judgment and our standards to report and audit the same. Okay, and also the documentation matters in communication. Like I said, my CEO used to say, if it is not documented, this is not done. So documenting your justification and whatever it is that is a deviation from any standard or its application, the application of the standards must be documented and not only communicated orally. So communicating any significant difficulties encountered during the audit is also very necessary. So any significant difficulties and challenge that bedevil the audit must be documented and communicated appropriately. Communicating any significant matters arising, like material misstatements and significant issues in the audit that were discussed or subject to correspondence with management, is very important. So communication is in writing as well as orally. So any significant issues should be communicated, like control deficiencies, internal control matters must be communicated and discussed, and it must be put in writing. So that will be it for ISA 260. And in summary, everything about ISA 260 talks about documenting your evidence, document your communication as significant as it is. Don't just say, we said it, we informed you. Okay, when did you inform them? Where is the evidence? You don't have. So it's very important that auditors document everything. Like I say, and I reiterate that if it's not documented, it is not done. In the words of my current CEO, it's very important to take note of that. And that's, in summary, what ISA 260 meant or means. Okay, so if we don't have any questions, please be free to interject in looking at these standards, because they are very important in the application and during the exams also. If you don't have any questions on ISA 260, let's move to ISA 265, communicating deficiencies in internal control. Yeah, this is my area, and most of the times internal auditors or external auditors always tell this area is actually directed to me, the internal auditor. So most of the time when there are control deficiencies, they will first call the internal auditor and say, see this, they don't have this, they don't do this, they don't do that. And I'll have to take note of that so that I can add it to my audit plan and make sure those issues are not repetitive or repeated in future. Okay, so communicating deficiencies in internal control to management is also important. And that is what ISA 265 is all about. It's a new ISA which is intended to improve the auditor's communication of deficiencies in internal control identified by him. So the internal audit is also primarily charged with the responsibility of identifying deficiencies in internal control, but where it skips the internal audit, the external audits can point it out, and also the internal audit should take note and make sure follow-up procedures are performed to ensure that those deficiencies are remediated within the time provided by management, and they don't keep occurring on the year-to-year internal audit basis. So the communication is what this standard is all about, and he needs to be able to communicate properly to management on these deficiencies that were identified during his audit work. So the term deficiency in internal control is defined thus. The requirements include determining whether the identified deficiencies constitute significant deficiencies. So if these deficiencies are significant, so for example, in the cash unit, one receiving cash as a form of revenue, one of the control is that there should be cash count certificate. We are all aware of that if we worked in a place where they receive cash substantially as part of their revenue receipts. So where cash is received, before moving to the bank, there should be a cash count certificate that validates that this cash was counted, signed off by the different parties, cashiers, accounts, audits, before moving to the bank. So where reviews are done and cash are just moved internal and external to the bank without any certificate, that is a control deficiency. So the internal audit needs to point that out, and if it passes the internal audit, external audit is supposed to flag it. So another control deficiency, for example, is stated in the policy to have bank reconciliation every month and a statement issued after the bank reconciliation. And during reviews, they don't see any bank reconciliation or statement. That is a control deficiency. So the internal controls behind those two examples I've stated have been deficient. They are not working. That is what it means. So we need to determine whether the identified deficiencies constitute significant deficiencies in terms of, are they highly risky, lowly risky, or medium risk that will impact the organization's operations and the decisions of stakeholders, management, and the owners of the company. So the significance of those deficiencies are very important in the remediation, and that is why those deficiencies are rated high, medium, low. They are risk-based in their rating. It's very important. So when we do external audits, one of the things that they report to the board just the same way I report it to the board as internal auditor, is to report control deficiencies to the board of directors. So the significant ones are reported based on the high, medium, low method. Now, communication in writing of all the deficiencies includes a description of the deficiency and the possible effects. So the description is the risk and the impact. The risk and the impact. What is the impact on the operations of the center or the organization? So the significant deficiencies provide the description of the deficiency and how it impacts negatively the operation of the center. And aside the impact, the effects is very important. Okay, so that's for ISA 260, looking at 265, sorry, looking at communication of deficiencies in internal control. If we don't have any question, we look at ISA 320, materiality in planning and performing an audit. In the revised 320 standard, updating the definition of materiality to make it clearer that materiality depends on the size and nature of an item. Size and nature of an item, judging in the surrounding circumstances. So size may mean 10 naira in an organization, if it's missing, may be significant or insignificant to an organization that 100 naira is missing in. So for example, in a big organization, 10 naira may not be significant in size or nature to stakeholders. So if you find 10 naira missing when you're counting cash or reconciling, it may not be significant. But if you find 100 naira in an organization missing, it may be significant because that 100 naira may mean a lot to somebody, and that's what materiality means. So also 10,000 naira may not mean anything to my company. If it's missing, we may just flag it. But 10 million naira is material. So that's talking about size and nature, judging the circumstances surrounding the organization. So introduced guidance on the use of benchmarks for the initial setting of materiality, but does not set formula rules. So benchmarks are set. So for example, they may just say 10% of revenue can be the materiality threshold. 10% of revenue, or 25 million or 5 million, depending on the organization. So for a bank, it may be in billions. Any transaction that is shady within 2 billion, 1 billion is material for them. So during the audit, any figure or number that is being audited that is not clear, the materiality threshold or the materiality flag comes on. So there's no specific formula that states this is the materiality benchmark. So for organizations, it depends on the largeness. And management may also request that, okay, this is our materiality threshold. Anything that is above this that is not clear, please bring it to our attention. But most audit firms set the materiality threshold during their assurance engagement work to say this percentage of an amount can be set as the benchmark. So where clarity is, when they are not clear about a particular transaction and the amount involved, they will sit on it till there is clarity and they have a level of comfort and evidence to back that transaction or that event. Take note of that. Okay, so indicated that during the audit, the auditor should be alert for possible management bias. Possible management bias. So during the materiality threshold setting and their work, the auditors should be ready to take note of management bias, in the sense that they will be biased such that when evaluating whether financial statements are a whole, they are wholly free of material misstatements, the auditor is required or considered both to be incorrect, or his qualitative aspect of the entity's accounting practices are called to question. So management may be biased and they may not agree with some of the auditor's assertions, and then the auditor must stand on the premise that the financial statements are free from any material misstatements required during his during its review. So any incorrect misstatements should be flagged, and qualitative aspects of the entity's accounting practices is very necessary in the audit. So the auditor should not be brought under any form of pressure, no matter management's bias and their defense to any of the auditor's findings. He has to be objective, irrespective of any of the organization's management bias. Now, the International Audit and Assurance Standards Board conclude that it will be better to address materiality and the evaluation of misstatements in separate ISAs, which led to the creation of ISA 450. So the addressing of materiality is very essential, and evaluation of misstatements are also in separate ISAs to provide independence and clarity, specificity in both of these standards. So for materiality, there's a standard, and misstatements, there's also a standard. They are not joined together. So let's see ISA 450 on the next page. So the new requirement of ISA 450 talks about determining a lower amount called performing materiality for the purpose of assessing risk and deciding on appropriate audit procedures. So performing materiality is separate from misstatements for the purpose of assessing risk and the impact of the same in deciding appropriate audit procedures. So revising materiality during the audit, the auditor becomes aware of the information that would have caused him to initially have set a different threshold. So revising materiality is important for the auditor where the organization have not specifically stated this is their materiality threshold. And specific documentation requirements for threshold determine and any changes made during the audit is important. So documentation of the materiality threshold is not just oral or communicated verbatim to management. There should be specific documentation requirements, reasons, and conditions why those thresholds are determined. And if there are any changes during the auditing, whether changes up, review upwards of those thresholds or downwards, it must be communicated in writing, and there must be requirements for that. And that's what this ISA is talking about. So ISA 402, audit considerations related to an entity using a service organization is stated, and the revision of that standard reflects the increased use of service organizations. Now, ISA 402 talks about audit consideration related to an entity using service organizations. So, for example, in my office, we have service organizations that provide a particular service that we didn't employ staff to provide. So this ISA covers that extensively. Outsource services. So the need to bring the ISA into line with the risk assessment is very important. And the requirements include specifying matters to be included in the auditor's understanding of how the entity uses the services of a service organization is very important. So we need to specify in specific terms, documented, that this is the auditor understands the entity and the services of the service organization. So, for example, the outsource firm we use, normally independently, the auditors write them that, okay, this is the balance, maybe as accounts payable or accounts receivable that is in the account of this company. Can you confirm the validity or trueness of it independently? And most of them make calls to these organizations to be able to validate that the services are actually provided, because sometimes some organizations will outsource services to fictitious organizations that don't exist by way of fraudulent activities. So it's better the auditor verifies the authenticity of these services employed by the organizations and audit them also to block leakages and validate that the transactions are correct. So auditors do that. So where the auditor has concluded that the controls at the service organization operates effectively and efficiently, specific procedures to be performed in testing the operation or operational effectiveness of those controls includes obtaining type 2 report. So type 2 report talks about operational statements and documents. So for example, like I've stated, accounts payable, accounts receivable, maybe the organization runs contracts with the service organization. So type 2 reports are typical evidence, testing the controls of that service organization and using another auditor to test controls at the service organization. So where the primary auditor does not have expertise to audit the service organization, they can use another auditor that have that expertise to test the controls at the service of the organization, and their charges is on the entity or the main entity they are auditing. So using an auditor is very important to validate that their services are correct and the testing is in line with the expert that provides that service. So specifying procedures to be performed if the auditor plans to use a report from another auditor as audit evidence is very important. So procedures should be specific and documented. So where the auditor plans to use an auditor to get the auditor's evidence and his expertise, he must be satisfied with the other auditor's professional competence. So take note of that. So where the auditor is not competent enough or feels skeptical about his experience and expertise, he uses another auditor, but he must be clear that that auditor has professional competence and independence and can follow the standards applicable in doing the work the auditor requires. So procedures to determine whether type 2 report provides sufficient evidence about the effectiveness of controls at the service organization is very important. So obtaining that evidence is necessary, and it must be sufficient enough for you to be able to pass your opinion or judgment to management. Okay, so specifically ISA 450 will be talking about evaluation of material or misstatements apart from materiality. The evaluation of misstatements identified during an audit is specifically what this ISA is all about. Don't forget that it's been stratified and divided. So we have materiality and we have misstatements, evaluation of misstatements differently in the revised ISAs. So as explained, ISA 450 arose from the revision of 320, which has to do with materiality. So there are a number of new requirements which include accumulating all identified misstatements other than those that are clearly trivial or not significant. So identifying them and accumulating them during the work or the job done is important. So prior to evaluating the effect of incorrect misstatements, revising materiality, we need to document them, have them down. Auditors need to have every misstatement issue documented in reassessing their materiality. So determining whether incorrect statements or misstatements are material, considering their nature as well as their size. So their significant size and volume matters in determining misstatements. So misstatements of 10 naira, 20 naira may not be as significant of misstatements on 100 million, 10 million, 10,000 naira, depending on the organization. So the size and nature, it's very important. And in documenting them, the amount below which misstatements will be regarded as trivial is very important. The amount below whether misstatements will be regarded as trivial is very important. So in fishing out misstatements or flagging misstatements, if those amounts are material, will it affect decision making of the stakeholders or the owners of the company? That's the triviality we're talking about. All misstatements are accumulated during the audit and whether they have been corrected. So irrespective of the significance or the amounts involved, all those misstatements during the audit work, you need to ensure they are corrected. Not to correct them, the auditor cannot correct because he cannot flag. They cannot be the judge and the jury at the same time. So he needs to flag, then management and the team correct it. So that's in documenting that have they been corrected. Also the auditor's conclusion as to whether uncorrected misstatements are material, individually or in aggregate, and also the basis of that conclusion. So the auditor's conclusion on this ISA 540 issue of misstatements, whether it's one or it is incorporated in a whole transaction, and the basis for that conclusion must be stated in documents, in writing, and whether this conclusion has stated that this is our valid facts or the auditor's valid facts on the incorrect misstatements and his conclusion. Okay, so that will be it on ISA 540 on material misstatements, evaluation of material misstatements. So if we don't have any question, let's move to ISA 505, which is external confirmations. External confirmation. So the revision of this standard was in response to the concerns that requirements in this area needed to be more rigorous. It needed to be more wide and all-encompassing. So external confirmations, like I've stated in one example, I said, where service organizations are used by an entity, the auditor needs to confirm that any transaction or business engagements are true and valid. And in these external communications, the AG's area needs to be more rigorous, and that is why the revision was pertinent. So compared to the previous version of ISA 505 on confirmation of external confirmations, more detailed requirements in relation to maintaining control over the confirmation request is very important. So control should be independent, since it's the auditor that is making it. Management or the team should not provide that confirmation, so it should be independent. So there should be control in the confirmation request. Obtaining further evidence to resolve doubts over the reliability of the response of the confirmation is also very important. So where there are dichotomy or differences in opinion or results obtained, the evidence to resolve doubt over the reliability of this information should be also provided by the auditor. So conditions which must be present if negative confirmations are to be used. So where negative confirmations are to be used, there should be conditions that are present, that the same way there are conditions for positive confirmations. This is very, very key. So ISA 540 auditing accounting statements include fair value, accounting estimates, and related disclosures. So having looked at ISA 505, ISA 540 on auditing accounting estimates, fair value, related disclosures is what this standard is all about. It was revised to improve the rigor of auditing of accounting estimates, particularly in view of the potential for management bias, lack of objectivity, or management's argument in the earnings management by manipulation in this area. So this talks about provisions and their estimates, their forecasting. Management could be outrageous or very, very ambitious in their estimates. So in auditing these areas, auditors need to be objective, so that potential of management bias in reporting earnings, redeploying earnings, maybe earnings that are provided for dividend, redeployed back to upload back as profit to the organization is very important. And management could manipulate this area to report favorable outcomes. So auditors need to be careful in auditing these estimates and judgments or provisions by management. So the revised standard, ISA 514, introduces requirement for greater rigor, wider work, and skepticism in this area. It also provides standards and guidance on what constitutes a misstatement on indicators of management bias. So in this area is very important because this standard states to put requirements down and conditions on what constitute misstatement of these accounting estimates and whatever it is management is projecting or making provisions on. So any indicators of management bias that are not correct, this standard helps to provide rigorous work on and skepticism in this area to put management in check. This is very important. So this standard also focuses on areas of estimation, uncertainty, and risk. It aligns more closely with the audit risk model. And the new requirements include obtaining an understanding of how management identified the need for those accounting estimates. So we need to know how those estimates came about. What's the need? Why did you come about that? And how did those estimates come up? And also reviewing the outcome of the accounting estimate made in period. So if you are reviewing for a particular period, what is the result and the outcome of those estimates in previous period? We compare them and juxtapose them in our testings and our work, or the auditor's work. Also evaluating the estimations, the uncertainties, and whether they are high and may lead to significant risk. So evaluating those estimates and the uncertainty are very important also. So for identified significant risk, the auditors need to evaluate how management have considered alternative assumptions or outcomes. So if there are alternatives, how did they come about those alternatives? So estimates are estimates, they are not reality. But then in accounting, you have estimates, you have provisions, but they have to be realistic, not just wild estimates. You can't say you estimate to make 2 billion when you know that the current reality you cannot make 1 billion as revenue, for example. So it's very important that evaluating management estimates and their alternatives are realistic, and auditors need to be skeptical about this. So obtaining also sufficient appropriate evidence about whether management decisions are in accordance with the applicable financial reporting framework is also very, very important. And evaluating the adequacy and disclosure of the estimation of the management's assertion and their uncertainties is also very important. So we need to evaluate as auditors the adequacy of those disclosures of the estimations or certainty. Reviewing management's judgment and decision in order to identify possible management bias is also critical. And that is very important in understanding estimates of management. Okay, so let's look at ISA 550, which has to do with related parties. It was also revised after the recent major collapse of Enron and WorldCom in 2002. And this involved related party transactions and the need to focus more on risk-based approach in line with other ISAs. So risk-based approach talks about the risk and impact in every estimation and transaction that we are looking at. So what is the risk, what is the impact, and the likelihood of those risks you've identified. The revised ISA 550, which also seeks to assist auditors with the difficult task of identifying related parties among the disclosed related party transactions, are very important. So these transactions can be tricky. They involve related parties, maybe a director using his wife or close relative as a company or a transaction in his entity. So those transactions are risky and they could be fraudulent, and that is why it's very important that this is taken note of by auditors. So what are the new requirements? Considering the susceptibility of financial statements to material misstatements due to fraud arising from the entity's related party relationships and transactions, obtaining an understanding of the controls put in place to identify, account for, and disclose related party transactions and relationships, and to approve significant transactions outside the normal course of business is very important. So the controls in place are very important. There are some company policies that don't allow related party transactions, and where it's allowed, controls must be in place, and these transactions must be stated clearly. Who are those related parties? What are their relationships? and how do they impact? What are the significant amounts involved in those relationships? If contract is provided to a company by a related party, what is the amount? And scrutiny must be very, very graphic to ensure that adequate controls and abuse and fraud are not perpetrated through these transactions. So treating significant related party transactions are giving rise to significant risk. Exactly. So where the auditor senses there are significant risk in the amounts of these material transactions, then treating them significantly is very important. So specifying procedures to be performed if the auditor identifies related parties or significant related party transaction that management has not previously disclosed to the auditor is also important. So where samples are tested, compliance testing are performed, the auditor finds significant risks there or outcomes, he needs to perform more or substantive testing, especially where management has not disclosed the nature of these related party transactions to him. So he needs to go deeper to uncover issues that may not be necessarily provided to him by management. Of course, management will cover issues like this because they are related party transactions. Also, specifying procedures to be performed for significant related party transaction outside the normal course of business is also essential. So the auditor can go outside of his way from the normal course of business to perform substantive testing on this area. It's a significant area that fraud may be perpetrated. Also, obtaining sufficient appropriate evidence about management's assertion that a related party transaction was conducted on normal commercial terms is very important. So, appropriate evidence in form of writing, documentation, contracts, SLAs, service level agreements in writing, the auditor will obtain that where related parties are involved in commercial terms and document them as his evidence. Okay, so that would be for related party standard. Let's look at ISA 580. What's the time now? Okay, we have a few minutes more. ISA 580, written representation. These standards are actually long, and we need to just be patient. ISA 580 was revised to respond to concerns that the auditor may have over relying on written representations. So the revised ISA 580 introduces a number of significant changes. The main one is that it is made clearer that although written representations provide necessary audit evidence, they do not on their own provide sufficient appropriate evidence about any of the matters included. So that's one of the clarities and the tweaking, revision of this standard that went on. So evidence does not mean it's sufficient and appropriate. That you have evidence does not mean it's sufficiently appropriate in that circumstance. So the new requirements include obtain written, the auditor is to obtain written representation about management's responsibilities, and it must be clearly in writing, which includes preparing financial statements. Exactly. We've talked about that. Providing the auditor with access, recording all transactions reflected in financial statements. Management does not provide above disclaiming opinion. So management does not provide disclaiming opinion on the financial statement should be the auditor's option. So a disclaimer provided by management should not be provided. So the auditor should use that as an option, and based on his judgment, he should know whether there's an issue with the management's assertion on this written representation of the management's duties. Option of a disclaimer of opinion is at the judgment of the auditor. Okay, so having looked at that, ISA 600 talks about special considerations, audits of group financial statements, including the work of component auditors. So just be patient to soon round up this session and we'll close. So specific considerations like the audit of groups and large corporations where one auditor may not be sufficient, joint audits are needed, is what is looked at here. So the revised ISA introduced a number of new requirements where other auditors audit group components and their subsidiaries, increasing the group auditors' involvement in the work of component auditors. So what are the new requirements? In deciding whether to accept or continue an appointment as group audit, considering whether the group engagement team will be able to be involved in the work of component auditors to the extent necessary to obtain sufficient appropriate audit evidence. So the need for component auditors or joint audits is as a result of the largeness of the size of transactions or the companies involved. So joint audit may be necessary to achieve sufficient coverage in the audits. Very important. And in achieving sufficient coverage of the audits, sufficient appropriate evidence, not just evidence, is necessary to support the work done and the opinion reached. So obtaining an understanding of the group, the components, subsidiaries, related companies, associates, and the environment of the business, assessing the risk of material misstatements, materiality, the group financial statements, which can be mitigated by strong wide group controls, is very important. So understanding the group's business is key. The risk in the organization's typical industry and sector of business is also key for the auditor. And also obtaining an understanding of component audits, including their professional competence and whether they will comply with ethical requirements which apply to the group audit, is also important. So the auditor needs to understand this very, very holistically. Also determine the materiality of that group as a whole and for each component where the auditors perform an audit is also very important in reviewing the purposes of the group audit. So group companies are mostly very big, where they have different conglomerates and associates, subsidiaries. It's very important that understanding the nature and not just jumping into the work will help them provide sufficient and appropriate evidence. So responding to assessed risks include requiring an audit of the financial information using component materiality of any component which is of individual significance. So in auditing financial information, the components of materiality for each component, let's say the holding, the subsidiaries, are very important, and it must be driven by financial significance where amounts and figures are material to transactions. They need to be taken cognizance of and noted by the auditor. So requiring an audit of the financial information or an audit of specific areas or specific audit procedures for any component which is significant because it is likely to include group level significant risk is also very important. So where extra audits are needed or extra reviews, specific audit procedures are likely for areas where they find out significant risks are resident. So the inherent and the residual risks, if it's high, the auditor needs to perform additional procedures. So this is very important for components of groups that are highly volatile. Also requiring analytical procedures at group level for non-significant components is also good. So analytical procedures are a bit briefer and less substantive, can be provided for non-significant components of those groups or subsidiaries that don't really matter to their holding company. And also determining the level of involvement of the group engagement team in the work performed by component auditors is also key. So for significant components, the group engagement team must be involved in the component auditors risk assessment. Exactly. So in assessing the group, those components needs to be involved so that there will be integration and synergy, and also to identify material risks in that company in a whole, in a holistic form, not just in silos where individual components their risk assessments are done independently or differently. Aligning them synergistically is very important to identify significant risk of material misstatements as a group. This is very important. These ISAs have refused to finish. Can we stop here? ISA 620. I thought it would finish. The ISAs are so much. I know most of us are already asleep. ISA 620 is the...
Yes, sir, we can pull it to the...
Yeah, I slept off, I woke up, I slept off, I woke up.
I know. AC Umar, what did you say? Should we stop here? Maybe continue in ISA 620 in the next class.
We can complete by tomorrow, by the next class.
Yes, at the next class on Friday, exactly.
On Friday.
Yes, since we are in ISA 620, it's already 10:06. You guys need to rest. I beg. I don't mind. I can continue, but the standards are so much.
What I want to exaggerate here is that.
Thank you, Timothy. Yeah, please go ahead. Go ahead, Umar. I can hear you.
What I noticed nowadays, the ICAN, they are now pitching a lot of standards in their exams.
Exactly.
If you look at the recent exams that we have conducted, they have tested like more than 5 standards. Yes.
Right, exactly.
Therefore, we have to concentrate. We have to give more efforts on that standard so that we can go away with the papers, inshallah.
Exactly. Thank you very much for that comment. So please, let's take note of it. It may be boring. In fact, I find myself getting bored explaining them, even though these are practically what we do, because I work with external auditors and this is what we do. But then it's boring. But then Julie used to say something that is necessary. So just like Umar opined, is necessary. So let's see how to get value from this. Even after this class, go through the videos, go through our study text. I'll share this PowerPoint. Even with your phone, the PowerPoint is a bit, the font is larger. So please go through the standards. You're welcome. You're welcome. So we need to go through the standards again and again, like Umar opined. Last diet, he brought about 5 standards. So at least have an overview of the standards so that you'll be able to apply them to the concept. It's very important. So that we don't rush and not get the significance of the explanations, let's stop at this ISA 620. Then on Friday, we can continue. I think this is the longest in this second unit. This is the longest. So just be patient to conclude in the next class. Thank you, Umar, for that observation. Yeah. It's very, very value added. Thank you so much.
Get it. The Almighty be with you wherever you are.
Amen. Amen. Thank you for the prayers too. Sorry, do we have any other person commenting so that we can close? It's already 9. Okay, it's already 10:08. Any other